Good morning, all. Welcome back to the series of lectures on financial derivatives. In my previous lecture, I explained what is the meaning of derivatives, that is, what is derivative market, what is derivative instrument, what is derivative contract. Hope you are clear with the concept of derivatives up to now. Today, I want to explain about various components of derivatives. Means, if a derivative contract is existed between parties, what are the components are there? Once we are clear about the components, we are in a position to understand how the derivative is going to be worked. Now, let me start my proceedings. These five are considered as a components of derivatives. The first component of derivative is underlying asset, on which entire derivative contract is depends. The second one is a strike price. This is also known as contract price. The third one is a market price. This is known as a spot price of the underlying asset. Now, we have the two very important terms, long position and short position. These two, the long position and short positions are the position taken by the counterparties in derivative contract. The last one is expiration date. The expiration date is the date on which the contract is going to be expired. Now, let me explain the components of derivatives with an example. Let me take an example. Now, I am going to take an example of commodity derivative. In my previous lecture, I said what is a commodity derivatives. Said in commodities, it includes four types of commodities. One is agriculture commodities, means we have the agriculture commodity derivatives. Energy commodities, energy commodity derivatives also we have, as well as metal related derivatives also. Now today I am going to take agriculture commodity as an example to explain various components of derivatives market. Now what I am going to take? I am going to take wheat as an example. I am going to take wheat as an example. Now, in order to explain the derivative contract, definitely we require two parties. Now I assume that one party is existed here, is the first party. The name of the party is Ramu. I assume that Ramu is there. What is the profession of Ramu? I assume that Ramu is a farmer. Ramu is a farmer. What he cultivates? He cultivates wheat. He cultivates wheat. On each and every season, Ramu is going to cultivate the wheat. Once he receives the wheat, now he is going to sell in a market and encash his agri output. Now, what kind of risk that the Ramu has and how the Ramu is going to transfer his risk to the other parties with respect to the agriculture commodity? Name it wheat. Now, let us start the process. Now today I assume that today means 0 day. That's today. That's today. Today Ramu started his cultivation of wheat. It takes almost, I assume that 150 days to receive the output. Means if you start the cultivation today, it takes 150 days to receive the wheat. It may take another 20 to 30 days to sell his wheat. I assume that it takes another, I assume that 30 days to sell the wheat. Means what is the totally how many days? 80 days. Where we are now? We are into the today scenario. Now, today, what is the price of wheat? Let us take today, what is the price of wheat? Now the price of wheat is 2,500 per quintal. 2,500 per quintal. Now I said one of the underlying feature of any sort of market is variability in price. Today is a 2,500. We don't know how the price will be after 150 days. Especially Ramu don't know what may be the price after 180 days. Means 180 days you need to understand at the timing of selling his agri output into the market. Now there may be two outcomes. There may be two outcomes. I'm going to use this place. It is a 0 day. Here the price is 2,500. This is 180 days from now. Now after 180 days, there may be three outcomes. The first outcome is no change in price. What do you mean by no change in price? The price remains the same, 2,500 per quintal. The second, the price may be greater than 2,500. Now, the price may be less than 500 also, 2,500. Because future is uncertain, future is not within the hands of the Ramu, he is not going to control the price. If everything remains the same, the price is the same. But future is, there may be change because of lot of market related forces. In case of oversupply, what happened? In case of oversupply in market, what will happen? The price of wheat is going to be reduces because the supply is more. We need to, in economy, we have a concept. If the supply is more, the price will fall down. What happened in case of over demand? In case of over demand, the price will be increased more than 2,500. Now assume yourself is a Ramu. When you will be happy? You will be happy if the price is less than 2,500 or if the price is greater than 2,500. As a Ramu, as a farmer, you have an output, you want to sell it, now you want to encash the money. Definitely, you are on the seller side. Means Ramu is on which side? Seller side. You are going to sell the wheat. If you are on the seller side, we always feel happy if the price is increases. Means if the price is more than 2,500. We feel sorrow or otherwise we feel disappointed if the price is reduces, because once the price is reduces, my cash flows reduces, profit reduces. Sometimes I'm not in a position to get back the returns which is sufficient to meet all my expenditure for entire process of agriculture, entire process of cultivation of wheat. Such a kind of issues are there. If it is greater than 2,500, I'm okay. If it is less than 2,500, I'm not okay. That's a thing you need to understand. What happens if the less than 2,500? Your cash flows will be reduced. Your returns will be reduced. Now everything is going to be reduced. Now at this point of time, Ramu may sense the risk. Ramu may sense the risk. Ramu may sense the risk. Means since the future is not in the hand, that's why in future the price may fall down. If the price or fall down, then cash flows can be reduced. Once the cash flows are reduces, now returns are going to be reduces. Then what the Ramu is going to do in order to overcome the risk, in order to hedge himself from the risk, what he's going to do? He's going to in simple terms, he's going to take the help of a contract. He's going to take the help of the contract. Now, what is a contract? Ramu is looking for a party who is ready to buy his wheat. Make sure Ramu currently doesn't have any wheat. Ramu is going to receive the wheat after 180 days only. After 180 days only, he is ready to sell. That's why Ramu need a person who is going to purchase the wheat, not right now, after 180 days. Means Ramu is searching for certain parties, certain what is called it as an institution, certain companies or factories, like wheat flour factories, means atta making factories. Is looking for atta making factories. The atta making factories may purchase the wheat on a bulk size. Now, assume that he is looking about some party. Now assume that one party is available. Now this party is, assume that the party is, this is atta making factory. Means they purchase wheat and convert into flour, processing into the flour and convert into the atta and pack it, and they market the atta. Now Ramu approached a atta making company. Now, what exactly the conversation between Ramu and atta making factory? Ramu is going to sell certain quantity of, assume that certain quantity. What may be the quantity? Let us take a quantity. Assume that 100 Q means 100 quintas. Ramu is ready to sell 100 quintas after 180 days. Once he ready to sell 100 quintas after 180 days, someone is ready to buy 100 quintas after 180 days. Now, atta making company looking for these kind of deals. Now, atta company, are you clear now? This is a factory. What they are going to do? They are going to buy. They are going to buy the wheat and convert into atta. That's the thing. Now, here the very important aspect between Ramu and atta making factory is at what rate? At what rate the Ramu is going to sell? At what rate the atta company is going to buy? That is a very important aspect. Means both the parties need to agree upon a price. Both the parties need to agree upon a price. At what price? Both parties assume that Ramu ready to sell at 2,700 or 2,800 to atta factory. If the atta factory is ready to buy at 2,700 or 800, it is okay. Assume that they enter into a contract for 2,750. At what rate they enter into a contract? 2,750. What is the quantity? Here the quantity is 100 quintals. Here the quantity is 100 quintals. What is the date? Are you clear now? 150 days from now. Sorry, 180 days. Sorry, 180 days from now. Now, what is the contract is? Ramu as well as atta making company both enter into a contract. When they are going to enter into a contract, they are going to enter into a contract now for the period of 180 days to deliver 100 quantity of wheat at the price of 2,750 per quintal. It is a contract. Once they enter into a contract, both Ramu as well as the buying factory, atta making factory, consider the contract is an obligatory contract. Obligatory means you must fulfill the contract on the expiry date. Expiry date means on 180 date from now. That's why whatever may the price, what may be the atta price on 180 day, it may be more than 200 and 750 or less than 200 and 750, both the parties need to accept the contract and deliver 100 quintas to the atta factory. Then atta factory need to pay the amount, concern amount. How much amount? 2,750 into 100 means the total worth of the contract, total value of the contract is 100 into 2,750 means 2,75,000. That is the entire worth of the contract. That's they need to pay. Irrespective of whatever may be the changes happens in future. It may be price may be greater than 2,750 or greater than 500, less than 500, whatever may be the price. Are you clear now? We are not concerned about the future price. We are only concerned about the contract terms and conditions. Let me reiterate what are the contract terms between Ramu and factory. Here the contract terms are, they enter into a contract for 180 days to deliver 100 quantities, 100 quintals of wheat at a rate of 2,750. Once they enter a contract, this kind of contract is known as a derivative contract. What kind of contract? It is known as a derivative contract. Here the part, initially I said a point, risk. Now how Ramu manage the risk here? Because Ramu has a risk if the price is fall below 2,500. But fortunately, Ramu has a wonderful contract at 2,750. Means whatever may be the price in spot market after 180 days, he is able to sell at the rate of 2,750. This makes really happy for the Ramu because the contract is really favorable. On the other hand, for atta making also, they have their own analysis about the future. They may feel that the price may be go beyond 2750. That's why they may be enter into a contract. Here are the things you need to understand about what are the things involved in this contract. Before the what are the things involved in this contract, let us understand what is going to happen after 180 days. Let us understand what is going to happen after 180 days. Now, let me clear this. Let me clear. And again, I want to write contract terms, two parties. The first party, Ramu. Ramu is, who is Ramu? Ramu is a seller of wheat. Then we are having one more party. The party is a atta company, atta factory is a buyer. What is the contract terms? Here are the contract terms. Let me specify the contract terms. Here the period means 180 days. The contract is for 180 days. Now, here the UA means underlying asset. What asset they are entering into a contract? That is known as underlying asset. What is the asset they are entering into a contract? Wheat. For wheat, they are entering into a contract. What is the contract price? The contract price is 2,750. What is the quantity? The quantity of contract is 100 quintals. 100 quintals. This is a contract. Now, they enter the contract today. Clear now? Now, the contract is for 180 days. Assume that 180 days is over. Now, during the period, Ramu received wonderful outcome, wonderful agri output. Now, he received very good quality wheat and he has a sufficient quantity, 100 quintals, and he is going to deliver the 100 quintals to the atta factory. Then what is going to happen today? Today means at the time of entering into a contract, the price is 2,500. What happened during the 80 days? The price may fall or increase, whatever it may be. The price may be increased or otherwise reduced. 2,500 may be increased or otherwise reduced. Assume that on the day of 180 days, now the price is moved at 2,900. What is the price of atta on 180 days? 2,900. Now think from the Ramu side. Ramu entered into a contract at the rate of 2,750 means irrespective of the changes in price, in spot market, you are ready to deliver at 2,750. Now what about Ramu? Ramu is a loser or gainer? Is there any profit for Ramu or otherwise is there any loss for Ramu? Then we can understand if at all Ramu is not had a contract, not entering into a contract, what it would be? The price will be 2,900. He is able to sell entire 100 quintas at 2,900. Total he is going to receive 2,90,000. But what about the contract? Because since he entered into a contract, how much money the Ramu is going to receive? Ramu is going to receive this money on 180 days. How much money? 2,750 into 100 quintas. Now how much? 2,75,000. This is the amount he received. What happened if the Ramu is not entering into a contract? If the Ramu is not entering into a contract, on the day what is the market? 2,900. He must have received that amount. 100 into 2,900. Now how much is going? He must receive 2,90,000. Instead of 2,90,000, how much he received? 2,75,000. But on the expiry date, means on the maturity of the contract, we feel that we are the loser of 15,000. But at the time of entering into a contract, we may fear. What is that fear? In the minds of Ramu, the price may fall below 2,500. I may incur the losses. Now the contract price is more than 2,500. You are able to generate more than 2,500. Means you need to satisfy with the How much it is? At the contract price. At the time of entering into a contract, you are accept the contract. That's why you need to take it as a normal. Means your risk is covered, whatever may be the price. What you are going to do? Your 2750 is locked. Means irrespective of the changes in the price on the maturity date, you are going to receive 2750. Look at on the other side, auto making company. At what rate they are going to, what is called it as a receive the auto? 2750 means they are going to pay 2,75,000. What happen if the auto company is not entering a contract? They must pay 2,90,000. How much amount he saved? He saved the total amount of 15,000. He saved the total amount of 15,000. But what about here? He lose the total amount of 15,000. Now this is scenario 1. What happened if the price is on the other side? What do you mean by price is on the other side? The price is not increased. This may be the scenario 2. The price is reduced. Now the price is not 2,900. This may be scenario 1. Means this is a case 1. This is a case 2. What happened? What happened if the price of the particular wheat is in spot market on the 180 day fall to 2,300 or 2,500? Make it as a 2,500. What happened? Instead of go for a market, if at all you are into the spot market, you will receive 2,50,000 only as a Ramu. But once you are into the contract, how much you received? You received 2,75,000. What happened to the auto company? Instead of entering into a contract, once he is looking for a spot market, he may receive, how much it is? He may pay 2,50,000 instead of 2,75,000. He is a loser, but he is a, what is called it as a gainer. Then, here is a contract. Both the parties enter with an exception of, there is a certain price changes. The price changes may be adverse according to them. In order to cover those losses incurred because of the adverse price movements, they enter into a contract. The price is favorable. That's why they need not to concern about what is going to happen at the end of the contract. It may be positive, it may be negative for if the positive for one end, that may be negative for counterparty. That's why you need to understand. Means your profit become my loss become your profit on the day of expiration, means on maturity date. This is a simple way of understanding about a contract using wheat as an example. Now let me derive certain things from my explanation. Now here are the two parties. Who are the two parties? One is a Ramu. Now let me take the key outcomes of the example. We have two parties. Who is the first party? Contract between two parties. Who is the first party? Ramu. Who is Ramu? Ramu is the seller. Now what he is going to estimate? He estimated that at the time of entering into a contract, the price of wheat is maybe reduces. The price of wheat maybe reduces. If your intention is in future the price is reduces, you need to take up a position. You need to take up a position. The position is known as short position. Short position means you want to gain advantage if the price is falling. If the price is falling. What position Ramu held in the contract? Ramu held short position in a contract. What do you mean by short position? Short position is a position taken in derivative contract. They want to get the benefit when the price is falling down. Now, Ramu entered into a contract at the rate of 2,750. What happened if the price moved to 2,900? They incur the loss. What if the price reduced to 2,300? Sorry, 2,500? He gained an advantage. Each and every drop in price, he has an advantage because he frees the price at 2,750. Any fall in 2,750 is an advantage for Ramu. Now, what position he take? Short position. Now we have the second party. We have a second party. Who is the second party? The second party is a auto making factory. What is his expectation? His expectation is in future prices of wheat will reduce. Prices of wheat will, increase. Instead of, the price, if the price is reduces, if the price is increases, then what is going to happen? He may incur the loss. In order to hedge himself from the adverse price movements, he enter into a contract, to buy. What contract he entered? Buy contract. Such a kind of what position you are going to have? We are going to have short position. Short position is a contract you entered. If the price is reducing, you will get a loss. If the price is increasing, you will get a profit. Like Atta making company. Now, we have two positions, short position, long position. Short position is a position to sell a particular underlying asset. Long position is a position to buy a particular underlying asset. Short position is the contract for sell. Long position is a contract to buy. Now, Ramu take what position? Short position. Atta making company take what position? Long position. Now, what asset they are dealing with? Or what kind of things they are dealing with? They are dealing with wheat. Now, the wheat is known as UA. UA stands for underlying asset. Because the contract worth is going to be change, means a positive or otherwise a negative, depends on the changes into the wheat price. Since where we are going to assume the risk? We assume the risk if the wheat price is increased or otherwise reduced. That's why we keep wheat as an underlying asset and we derive the contract from the wheat. Then what is going to happen? There is a link between your contract and the wheat price. Once there is a link between your contract and wheat price, then what will happen? Now you will get benefited if the price is moving into the favorable direction. Means for short position, if the price is moving into the reducing manner, then you will get benefited. For long, if the price is into the increasing manner, then you will get the long position holder can get the benefited. That's why we need to take an underlying asset which is having a close link to your what is called it as the probabilities of losing areas. Now you have the probability to losing more because of the changes into the price of wheat. That's why we take wheat as an underlying asset. A change in wheat price, it may be increase or otherwise a decrease in a wheat price, may impose what is called as a certain gain or loss to the position holders. Certain gain or loss to the position holder. Now we have a two position. One is a short position, long position. Then another term we need to understand is the underlying asset. The base for. Suppose you assume that or otherwise you hold the stocks of SBI. You feel that in future SBI stocks will reduce. Then what you are going to do? If the SBI stocks are reduces, your portfolio worth or otherwise your investment worth is going to be reduces. Now how we are going to manage? We are going to manage to take a contract. What contract we are going to take? We take a contract and you need to hold the short position. You need to make SBI as an underlying asset. Once you make SBI as an underlying asset, there is a link between your stock and what is considered as a underlying asset. Then the movement of the underlying asset may give gain or otherwise a loss. Now, because you feel the risk is with the SBI, that's why you need to make underlying asset as a SBI. The common understanding or otherwise a thumb rule for underlying asset is where you are assume the risk, the same asset we can make it as an underlying asset. If you feel crude oil is risky, then you need to make crude oil as a underlying asset. If you feel wheat price as a risky, then you take wheat as a underlying asset. If you feel ICICI stock is a risky, then you make ICICI stock as an underlying asset. That's why you need to take most appropriate asset in order to cover the risk. What is the most appropriate asset? The asset is where you are assume the risk. That's why underlying asset is the asset which is having a close relation, or otherwise most of the cases, 99% of the time, the underlying asset is the same asset itself. Same as here, the underlying asset is a wheat, because we assume the risk only from the wheat. That's the thing. Now we have the first point, long short position, as well as we have an underlying asset. Then we enter into a contract at the specified price. What may be the price of wheat? We enter into a contract at 2,750. Means the price of the contract is freezed. Means the price is not going to be changed. Means the price is neither increased nor reduced till the maturity of the contract. The price is known as strike price. This is known as a strike price. This the same is known as contract price. The same is known as a contract price. The contract price is a crucial number for the both short position or long position holder to compare the short price, strike price, with a current market price. Now for the same wheat example, what may be the current market price in first case? 2,900. What is this 2,900? That is a spot price of wheat. That is a spot price of wheat. Which you need to understand. Now, what is the spot price? The spot price may be 2,900, spot price may be 2,800, the spot price may be anything, depends on the market dynamics on the expiration date. It may be for oversupply, it may be for over demand on the day. That factors may influence the price, means the price may be more than 2,900, less than 2,900, sometimes it is reduced to 2,000 also. What does it mean? This price is constant. Means once you are entered, that is a freeze. Whatever the spot price is not going to be constant. It's going to be continuously changed according to the market. The gain or loss is completely depends on these two. In our financial derivative terms, the strike price is known as X. Strike price is known as X. We are going to denote the strike price with X. We are going to denote spot price with a S. The difference between S and X means spot price and strike price will decide whether you end up the particular contract with a gain or loss. That is a key point everyone need to understand. Is it okay? Now one more point we need to understand. Now how many days we enter into a contract? We enter into a contract for 180 days. 180 days. What is this 180 date? The 180 date is a contract expiration date. From now onwards, on the 180 date, contract is going to be expired. Means up to 180 date, the contract is going to be live. The contract is not going to be expired. What happened on 181st day, first day? The contract is expired. The contract is invalid after 180 day. Means on 180 day, you need to settle your contract. Settle your contract means you need to make all the transactions according to the contract and finish all your obligations. That's all about. Now, I list out few aspects. One is position, short position, long position. The next one is UA. UA means underlying asset, strike price, spot price, as well as 180 days. What is it? Expiration date. This is with an example. We can list out all the components of the contract. Hope you got the example. Now, let me get into the details of what are the various types of components in theoretical manner. Now, these four, what are these four? The components of derivatives, underlying asset, for our example, wheat itself, strike price, for in our example, it is 2,750, market price 2,900, long position short position held by Ramu, long position held by Atta company, expiration date means 180 days from now. 180 days from now. This is for an example of wheat. Wheat means a commodity. It is an example for commodity derivatives. Means if the underlying asset is a commodity, that is known as a commodity derivatives. If you want to secure yourself from the adverse price movements of a stock price, means you need to take equity share as your underlying asset. Such a kind of derivative is known as a financial derivatives. Now, financial derivative, the derivative concept is the same, but how it is different from commodity derivatives and financial derivatives, it all depends on underlying asset. If you make The shares are underlying asset, financial derivatives. If you make indices, means the index like a Sensex, Nifty, Bank Nifty, that is also financial derivatives. Interest rate, financial derivatives. Bonds, financial derivatives. ETFs, financial derivatives. Or forex rates, foreign exchange rates, because forex rates are continuously changing. You can make forex rates also derivatives. What kind of derivatives? Financial derivatives. But what about if you make the commodities as underlying asset, like wheat, rice, pulses, vegetables, crude oil, metals like iron, zinc, aluminum? Clear? What kind of derivative it is? The commodity derivatives. Now the basic meaning of derivative is the same, but only the difference between a financial derivatives and commodity derivative is, if you deal with financial asset, that is a financial derivatives. If you deal with the commodities, that is with a commodity derivatives. Clear now? In coming class, I am going to explain about the theoretical aspects of underlying asset, strike price, market price, long position, short position. Hope you are clear with the example. Thank you. Thank you for all.